Welcome. Today's presentation is, will you outlive your income? And so when it comes to your retirement funds, there are many areas where you might want to focus your attention. Most of us know about the need to grow and protect your retirement funds. This may be an important consideration, making sure your retirement funds can last as long as you need them to. An area that perhaps you have not considered is taxes. Taxes, just like the growth and protection of your retirement funds, can be a critical component of ensuring you have enough retirement income to fund your needs. If you have saved all or the majority of your retirement assets in a tax-deferred vehicle like the IRA or 401k or 403b, 457, all of those, any change in taxes between today and the day you withdraw your last dollar of retirement income can impact the amount of income you keep and the amount you owe the IRS in taxes. This is what I call the rising tax risk. If taxes are higher in the future than they are today, it could negatively impact the amount of retirement income you have to spend. I believe taxes deserve an equal place in asset growth and protection when you consider potential risk to your retirement. Here's why. Here is a hypothetical example to show the importance of both growth and taxes on the amount of income, retirement income you could possibly or potentially have. Let's say you are ready to retire like this hypothetical person. He's 64 years old, has $1 million IRA. I'll assume he wants to make his retirement income last from age 65 to age 100. I've made a few assumptions about this individual's account. I've given him a 20% effective tax rate, which is low, a portfolio of 50% of his funds earning 8% in the stock market, and 50% of his funds earning 3.5% in fixed income. With those assumptions, this hypothetical person could generate an annual income of $50,000 from age 65 to age 100 without running out of money. But what happens if his account growth is less than he expected? Let's say his equity allocated funds only earn 5% instead of the 8% that he assumed. There would be an impact on the amount of income he could generate, of course. Now, instead of $50,000 a year, he could generate only $43,000 a year. Less growth than planned is a potential risk to retirement funds that many of us have considered. But then there's another risk that could be significant, and that risk is taxes. Let's say in this hypothetical example that the person's effective tax rate rose from 20% up to 32%. Because this money is held in a qualified account, in this case, an IRA, but it also could be a 401k or other tax-deferred vehicle. He would pay taxes on those funds when he withdraws the money in retirement. So instead of paying 20% effective tax rate on the income he generates, he'll pay 30%. Now, he might only be able to generate $44,000 a year instead of the $50,000 a year. We can't know what market performance or taxes may be now on your plan to retirement or in retirement. But we can work to understand how those forces may impact your retirement approach and discuss strategies to potentially reduce these risks. And that will be the point of our discussion today. A question on many savers' minds these days is, where are future taxes heading? Will taxes in the future be higher or lower than they are today? This could be a critically important question if you saved all or a majority of your retirement funds in tax deferred vehicles like the 401k or IRA. In these vehicles, you are deferring or postponing your taxes until you see, until you have access to your funds. That means that any changes to taxes between now and when you access your funds, positive or negative, will have the potential to impact the amount of retirement income you can access from your retirement account. When we think about the tax risk in retirement, when you save in a qualified account, one risk is tax rates rise. The other end up owing more in taxes than you plan. So in today's presentation, I want you to look at the risk of rising taxes and how you can potentially address that risk as you prepare for the future. Before you start, this is not a tax advice situation, even though I am a tax accountant. But my goal here is to help you understand better the issues impacting your taxes in retirement that you might also want to consider. There are three things that could possibly happen to your tax rate in retirement. It could be lower than it is today, the same as today, or higher than today. The first way is your tax code could vary in retirement is a situational change. Situational tax changes are changes based on something unique to you. This could be the level of income you desire in retirement or whether you're filing jointly or singly. This is the way some people often believe that taxes may be lower in retirement than they are today. I was one of those people who advised clients that if they saved in the 401k, they would be in a lower tax bracket. And that was absolutely the wrong concept, because now those same people who are also my clients still, they are in a higher tax bracket than they were 30 years ago. That's because of a key idea behind tax deferred saving. The idea is that in your working years, you're likely to be in a higher bracket. If that's the case, it makes sense to defer taxes or not pay at that higher rate. Then in retirement, you may be in a lower tax bracket. If this is the case, it would make sense to pay taxes in this future, lower rate in retirement. If this trade-off ends in being true to you, higher taxes today and lower taxes in retirement, then tax deferred savings may prove to be a good approach as far as your needs are concerned. But some of my clients are surprised to learn that lower taxes in retirement may not be likely when they consider retirement income goals and needs. And don't forget about this thing called the RMD, the required minimum distribution. So if you're using the tax deferred vehicle to save for retirement, it's important to consider if this equation is likely to hold true for you. For many of those in the greatest generation, that is before the boomers, this equation held true. This generation often reduced their lifestyle in retirement and in a way needed less income in retirement. By accessing less income, they were potentially able to lower their tax bracket in retirement as well. And remember, those are the people who had such things as pensions, and they knew that they were only going to get a set amount upon retirement. So now, what about the baby boomers? People were born between 1946 and 1964. Those are baby boomers. They have a lot of money now. So those who are not baby boomers will be able to access some of that money upon their leaving this earth. Some baby boomers may want to maintain their style of living and spending habits when retired, which could mean they'll need around about the same amount of income. So it's not as clear whether some baby boomers will be in a lower tax bracket in retirement than while working. Some savers who want to maintain their pre-retirement lifestyle in retirement may need roughly the same amount of income, both pre-retirement and post-retirement. If this is the case, it's possible that tax brackets would be approximately the same in retirement as perhaps they are today. Now, let us look at the ways taxes could change based on legislative or regulatory activity from the federal government. I want to make clear that this presentation is not endorsed by any government agency. And while no one can predict what new laws or regulations may come out of Washington, we can look at the environment our government is operating in when it comes to taxes. Some experts believe legislative factors are a way taxes could potentially be higher in the future than they are today, and that's without a doubt. The new spending that has increased put our deficit around $30 trillion. So what does this mean for taxes? Well, the government has to figure out some way to make up for the shortfall. And the only way to make up for the shortfall is to increase taxes. That's more revenue to offset spending increases. And so now we see ourselves presently in a debate as to whether we should spend or reduce taxes. Remember also that tax reductions really don't cover everybody. For instance, we've heard the president and his staff suggested that no one over $400,000 will see his or her taxes rise. Well, I mean, this is sort of kind of a political statement. When the so-called tax cut in 2017, only a few of those people took advantage, were advantaged by the so-called tax cuts, because many of my clients had to pay more after the 2017 taxes. So with that in mind, let's look at three potential ways future taxes could be higher. The first is an adjustment to tax brackets. We've discussed that brackets can change if you need more or less income, or if your filing status changes. But there are also ways tax brackets can change around you, even if nothing about your personal situation changes. That is because Congress and the president can change tax brackets through legislation. Currently, the tax brackets are set to rise in 2026. That's because of in 2017, that law was passed and it's scheduled to expire in 2025. That means unless Congress acts to extend the bracket reductions, all individual tax brackets will rise or revert back to the older tax rates in 2026. Brackets are the most common way many of us think about taxes rising, but that's not the only way. Another way is through loss of deductions. If you make $100,000 a year and can deduct $20,000 a year, you essentially have $80,000 in taxable income. But hypothetical, what happens next year if Washington changes the rules? And if the new law was passed and you could only deduct $10,000 a year, now you only have $90,000 in taxable income. In this hypothetical scenario, your tax bracket may not have changed, but you will end up paying more in taxes. A third way taxes can rise is if new income is taxes. Social Security is one example. Currently, your Social Security benefit may be taxed up to 85% of that benefit. But if some people changes the law that in Congress, perhaps they could make it 100% of that could be taxable. Again, if your tax bracket wouldn't change in this situation, but you'll end up paying more in taxes. This brings up to a concept I call legislative risk. That's the knowledge that our government could pass laws, whether spending bills or tax laws, that may have the potential to impact your future taxes. When it comes to retirement, you may say the tax code is written in pencil. It's unlikely that tax code we have today would be the same we have 10, 20, or even 30 years from now. Oh, and by the way, the deferred accounts, that's basically a loan from the government that is going to be recovered when you get to be 73. Some people may want to make macro approaches to taxes, which has a good potential of reducing taxes over your lifetime in taxes. Some people may want to take a macro approach to taxes. That legislative risk, as I discussed, is much more apparent through a macro approach than a micro one. But one way, I like to help clients by providing a macro analysis of potential taxes in retirement. This can analyze the total potential taxes a client may pay in retirement based on a variety of assumptions we make. For those who are saving, utilizing tax-deferred saving strategies, this analysis can uncover the potential tax cost or impact of deferring taxes. Let me show you a hypothetical example. Let's say we have another 64-year-old male. He's in a 25% tax liability bracket, and he has $500,000 in an IRA, and he has a 5% annual growth in his IRA, in his portfolio. Here are the potential taxes this individual could pay in retirement from his $500,000 of his IRA, based on the assumptions that we have made. He will pay taxes on the required minimum distributions. And then once he gets that retired minimum distribution, he's not going to spend all of that money. He's going to put that money in a bank account or some kind of other account. And then, of course, he will have to pay taxes that once he is deceased, his heirs will have to pay taxes. In fact, the new rule that was just passed this past December, the beneficiaries will have to pay REMDs on that money and have the money out of their account in 10 years. So let's look at the numbers. The amount that he's going to pay out of that $500,000, the RMD taxes will be $204,000. The amount of money that he's, once he reinvests in some other instrument, it's going to be about $96,000. And then his heirs will pay about $156,000. So the total taxes that this person and a whole lot of people I know have about $500,000 in either their IRA or their 401k, they will pay $456,000 in taxes. Now, another option some savers consider is converting a portion of their retirement funds to a tax-free vehicle. You may have already be familiar with one type of tax-free account, Roth accounts, such as Roth IRAs, Roth 401ks. Roth accounts may have different requirements and limitations than traditional IRAs and 401ks. So you will have to speak to a qualified professional about your current situation, because you can only put it's income related, as well as only a certain amount can go per year into a Roth account. So, but there's opportunity to convert some of those funds that you have in an IRA to a Roth account. And if that happens, that means they will have to pay the taxes. And of course, once you have to pay the taxes, it depends on what other monies that you're making during the conversions. So the immediate amount is $125,000 based on the fact that he's in 25% tax bracket. And then, of course, that money it's not taxable anymore because it's tax-free at that point. And then, so the hypothetical taxes paid when you do a Roth conversion is about $125,000. I would say about 6% higher than that because of the sliding scales of what happens when you add more money to your account. So the macro high-level analysis can help savers like you make informed decisions about the potential tax implications of their chosen retirement approach. And I can show you how I can run analysis for this. A lot of my people, once they contact me after this particular presentation. So in this hypothetical situation, there could be a difference between the taxes he pays if he converts his funds to a tax-free vehicle and the projected taxes he may pay keeping those funds in his IRA. The hypothetical example I just reviewed, assume this individual's tax bracket stays level throughout his retirement. But what happens if his tax bracket rose? Well, we have to ask, if his tax bracket rises in retirement, how much will it rise? There is no way to predict the future. So let's look at one data point from the past to kind of give an example of what might happen. The middle quintile represents the middle 1/5 of all taxpayers. The first and second quintile pays less in taxes, and the fourth and fifth quintile pays more in taxes. It's the middle taxpayer of America. It doesn't mean that you're middle America, you just in that quintile. So how have middle quintile tax brackets moved in recent years? So for this analysis, let's look at the year 2000, turn of the century, and then look at 2020. Since 2020 is the most recent year of federally produced quintile tax data. In 2000, earning the middle income of the middle quintile puts you in a 28% tax bracket based on a single filing status. In 2020, earning the middle income of the middle quintile puts you into a 22% tax bracket. For this middle quintile, tax bracket rates in the early 2000s were nearly 30% higher than they were in 2020. So what if taxes went back to that level? Our hypothetical example individual will now pay at a 32.5% tax bracket rate starting in 5 years rather than 25%, which is a 30% increase. So let's look at it again. The taxes paid at RMDs now would be $265,554. Tax paid on the growth of reallocated assets would be $110,000. And then the taxes paid by heirs would be $202 for a total amount, get this, $578,865. So off his $500,000 of money that he have set aside for retirement, taxes will eat up more than he had from the beginning. What happens if he converts? He still will only have to pay the $125,000 in taxes if he converts based on that scenario. So if taxes stay the same, this individual may pay $450,000 over time if he stays with a tax-deferred vehicle. If he converts it to a tax-free account, he will pay $125,000 in taxes currently. But if taxes rise, this individual will pay $580,000 over time if he stays with the tax-deferred vehicle. If he stayed with the tax-deferred vehicle, or we don't know where taxes will head, and therefore we don't know how much this individual may pay. This is why it's important to consider tax status of your retirement assets, making informed decisions about taxes in retirement. So that concludes the analysis of what I consider that, will your money run out before you do? There are two systems of taxation in our country. One for the informed and one for the uninformed. And the reason for this presentation is to leave you with informed concerns about what taxes will look like upon your retirement, and whether or not you should plan for that knowledge and put it to place. You have to have an informed decision about what to do with your money. So that is the conclusion of this report. Happy taxes.